Here now, head of macro asset allocation strategy at UBS Asset Management, Evan Brown, who also used to work at the Federal Reserve, the Bank of New York. The Federal Reserve Bank of New York was in the, bless you, the markets group during the financial crisis. What do you make of what we've been hearing from the Fed, from Jay Powell, particularly last Friday, and the market's interpretation of it?
Well, I think there's been a communication issue between the Fed and markets up until Friday. And Friday, Chair Powell got it right. He was on the panel and he was reading notes and he was clearly speaking to markets. And the tone was a lot more flexible. Mm-hmm. There was a message of patience. The Fed can afford to be patient. He pointed as a great example of Fed flexibility to the pause that the Fed did 3 years ago in 2016, essentially signaling, look, we're on hold and we're going to take our time, see how the economy plays out, listen to financial markets. And so that message now is a lot clearer than the one that we got from the December FOMC meeting a few weeks ago, which sparked this downturn in the market.
You know, there's still a 12% probability that investors are expecting a cut in interest rates this year. That was 50% when we started 2019, so it's come down to 12%. Is that still a possibility in your view, to cut interest rates?
Is it a possibility? Yes, but a very, very slim one. I mean, still of the view that the U.S. economy is on firm footing. Look, we're cooling off a little bit. We saw that from some of the business surveys, but we're not falling off a cliff. Look at the employment report last week. We're seeing household income rises, the employment gains, wage gains, hourly gains, labor force participation picking up. So this is not a sign of recession, and so it's hard to think cuts are coming in that case.
Historically, there is a 6-month period between the last hike and the first cut. But something that Stephanie Pomboy has pointed out repeatedly, that we've been talking about in the last year, it's about the balance sheet reduction. So you would expect the Federal Reserve to slow its balance sheet reduction before it ever turned to cut interest rates at this point. Well, yeah, you can disagree with that if you want.
Well, there was commentary about that in the minutes as well, that they could temper that.
Exactly, yeah. So which is another thing that I kind of wish Chair Powell would have brought up at the December FOMC meeting, which didn't come up. But yes, in the minutes, the Fed showed a lot of flexibility on the balance sheet. And to be frank, there was so much discussion. The Fed is still figuring out the balance sheet. They're still trying to figure out, okay, what kind of impact is this having on markets? And
I've said this all year. There's really no way for anybody to know. Not the Federal Reserve, not the smartest guys in the room, and not really anybody in the markets. Jamie Dimon told Maria in his interview earlier this week that people are talking about the inversion of the yield curve between the 2 and the 3 and the 5-year, where the shorter term rates were higher than the 5-year yield. And he said, but it's hard to judge. He doesn't know whether the yield curve is really telling us what it has in the past because of this gigantic balance sheet. And
And I think it's good, this sort of message of humility from the Powell Fed. It's good they're going to be data dependent, but it does raise a question of what is the data they should be looking at. I mean, if you mentioned market data, stocks go up and they go down. We don't want the Powell put, right? We don't want them saying deciding a certain level of the stock market requires monetary intervention.
Completely agree with you on that point. I think, look, the Fed has a dual objective, full employment and price stability. Those are going to be the two determinants, and the economic data that play into those are going to be most important. That said, if you get a severe enough decline in markets, it begins to weigh on sentiment, both consumer and businesses, and you have to think about the feedback loops there.
Yeah, look, exactly, feedback loops. Thank you, Evan. Because I'm a big student of George Soros and reflexivity. The markets absolutely affect the data, which affect the markets, and it goes in a cycle. It's been a vicious cycle. They're trying to make it more virtuous. It kind of actually throws me off, Evan, when you have actually Eric Rosengren, head of the Boston Fed yesterday, came out and said, we're a little mystified that what the market's doing isn't reflecting how the data has been strong coming into December, and yet we're still data dependent. To me, it almost seems a little, frankly, iron-headed to really suggest that and say, well, yeah, we don't know why markets are doing this. By the way, it's still all about the data. I mean, I think killing the tunnel vision actually is a good thing.
Yeah, I mean, look, we've had an avalanche of Fed speakers over the last few weeks trying to clarify this message. And to be fair, all of them have their individual opinions, and they should share them. But I think what's really going to be helpful is this year at every FOMC meeting, there will be a press conference. And so the central message will be coming from Chair Powell. We really need to focus on him. And I think he's learned from the past miscommunication issues, as evident by the fact that he was reading notes at that panel with former Chair Yellen.
Yeah, I have my bullet points open to changing balance sheet policy if needed to meet goals. Again, because I think there's a Q&A today at the speech that he's given down at the Economic Club in Washington. So again, use your talking points. If someone asks you something, use your talking points and just repeat the same phrase over and over again. I think boring is good at this point.
Yes.
I want to ask you about trade optimism. So the U.S. and China are concluding 3 days of negotiations in Beijing, two sides making progress, but no breakthrough on the trade dispute, which has clearly been a worry. What is your take on this?
Look, President Trump and President Xi, they want a deal. It seems pretty clear. We hear it in the reports that President Trump is concerned about the stock market. President Xi is, clearly the Chinese economy is weakening. He wants a deal as well. A lot of damage has been done. Now, this is still going to be a long-term story, and so hopefully the deal that we ultimately get is one in which the U.S. is still monitoring China and making sure that they're following through with what is ultimately promised.
Well, the Chinese economy, is suffering. So last night we had the biggest drop in producer prices in 7 years. First time the auto market in China has contracted in 20 years. So you know that the consumer is hurting, the economy is slowing down, and they badly need a deal.
But
yes.
President Trump needs to be reminded that what's bad for China can also be bad for the United States. The Wall Street Journal wrote that very editorial about the iPhone canary, about when China slows, so does the rest of the world. And you even had Kevin Hassett saying there's going to be more pain for American companies. How do you allocate? What does your asset allocation look like right now? Are you overweight stocks, underweight stocks?
So we're slightly overweight stocks. We do think that with the correction, you got some pretty attractive valuations. I think we were a little too optimistic. The market was a little too optimistic going into October, but then got way too pessimistic by the time we were at Christmas Eve. And so valuations are more attractive now. Look, the economy, global economy is fine. We're tilting a little bit more towards emerging markets just because we think even more bad news is priced in there. We actually think that the U.S. economy doing just fine, but cooling a little bit, and a more dovish Fed is going to mean a bit of a weaker dollar. So that should help emerging markets.
And a weaker dollar would... I want to ask you about small cap stocks here, because small cap stocks, in terms of the insulation from the trade problems, and really not swayed by the dollar as much because they're mostly domestic businesses. The earnings estimates on small cap are great coming into the new year.
Yeah, and we've seen a really nice rebound in small caps. I think over 10%
right.
since Christmas Eve. And so, another indication that there was just a little bit too much bad news priced in. Yes, small caps are a little less exposed to trade, but large caps are going to benefit from this dollar weakness. So,
right.
Look, overall, we think the U.S. equity market is going to do just fine, but we're tilting a little bit more. We just think emerging markets, ex-U.S., is a little cheaper.
Evan, thank you so much.